Get ready for an in-depth investment teardown of Cadence Design Systems, the AI silicon powerhouse driving the next generation of computing. We're breaking down its Q4 2025 earnings to find out if this EDA giant still deserves a spot in your portfolio. Today's analysis follows a clear four-step roadmap. We'll start with the bottom-line Q4 snapshots, move into the financial engines and segment margins, evaluate capital and valuation multiples, and wrap up with a bull versus bear risk matrix. The bottom line is a resounding beat and raise. Q4 revenue hit $1.44 billion, driven by massive AI infrastructure demand, while a record $7.8 billion backlog secures massive visibility heading into 2026. Looking at the Q4 snapshot, revenue grew over 6% year-over-year, while gross margins remained stable at a staggering 90% thanks to an 80% recurring software mix. Non-GAAP EPS beat consensus at $1.99. The margin story reveals a significant 1,600 basis point spread between GAAP and non-GAAP figures. This is primarily driven by $455 million in stock-based compensation, which reached roughly 8.6% of total revenue. Cadence's revenue engines are shifting toward AI. While core EDA remains the dominant anchor, semiconductor IP is the breakout star, with 25% growth fueled by high-bandwidth memory and advanced interface demand. Geographically, the Americas remain the largest market at 46%, acting as the primary hyperscaler anchor. Asia accounts for 32% of revenue, remaining a primary growth engine despite ongoing China regulatory headwinds. The balance sheet shows high earnings quality, with $1.729 billion in cash from operations, significantly exceeding GAAP net income. The company ended 2025 with $3 billion in cash and a focus on improving working capital. Management's capital allocation strategy is crystal clear: a zero-dividend policy focused exclusively on share repurchases. They deployed $925 million into buybacks in 2025 and pledged to use half of 2026 free cash flow for more. A major strategic spotlight is the €2.7 billion intent to acquire Hexagon's design and engineering business. This move aims to accelerate market penetration but brings significant integration risks for structural analysis software. The 2026 forward guidance is ambitious, targeting revenue between $5.9 and $6 billion. This implies double-digit expansion and a non-GAAP EPS up to $8.15, validating the strength of that record backlog. Is this pricing perfection? Cadence is currently trading at approximately 42 times its forward earnings guidance. The market is paying a premium for a highly visible 14% revenue CAGR and those elite 90% gross margins. The bull case rests on the AI supercycle, where tools like ChipStack have become mandatory for next-gen silicon. Additionally, big tech's shift to custom in-house silicon is forcing massive new demand for EDA tools. However, the bear case highlights regulatory risks in the Asian revenue base and potential M&A indigestion from the Hexagon deal. Investors must monitor the stock-based compensation spread and its impact on long-term profitability. So, is Cadence a buy at 42 times forward earnings? With bulletproof revenue visibility and AI monetization in full swing, the thesis is strong, but the entry price is steep. Drop your take in the comments. If you found this Cadence earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.